Hello, everybody. I would like to welcome you all. This is the first seminar we will be having with TPA Global. TPA Global is our partner in value chain analysis, transfer pricing, and some interesting issues at the international level. So we have long-lasting relations with TPA. So I would like to introduce Steph, who will make the presentation today. The key topic is value chain analysis and the next generation of transfer pricing. And we have a few questions we have to ask ourselves. The first question is, why should we perform a value chain analysis? The second question is, how to perform a value chain analysis? And the third question is, how does the VCA connect to a more transnational and transactional transfer pricing approach? These are the three main questions we are going to ask ourselves. And the answer will probably be value chain analysis and how the value chain analysis drives our worldwide tax position and the worldwide tax position of multinational companies going overseas. I stop here and I would like to welcome you, Steph, and please, Steph, the floor is yours, please.
Thank you, Pier Giorgio, and very honored to be here. I'm just trying to activate my video. I think the host should show me my video. It's still blocked, but that's okay. Thanks and welcome to all of you. We're going, as Pier Giorgio indicated, we're going to look whether value chain analysis is indeed the next generation of transfer pricing, and whether it will drive your worldwide tax position forward. If we go to the first slide, I've prepared for Pier Giorgio, you hear me?
Yes, very good.
Sound is good?
Yes.
Okay. Yeah. So the first of the four visualization techniques of VCA are called the pie chart approach. The pie chart approach basically takes typically a geographical slicing of sales, gross margin, operating margin, tax paid, and full-time equivalents or FTEs as a approach and slices it geographically. So I only took 3 out of the 5. So here you see, for example, UK has a lot of people working, but it only has 60%, 58%, but it only gets on the gross and operating margin 30%. China has quite some people on the ground as well. But as you see, China seems to be more of a subcontractor. If you see their slice in the operating margin pie, while the limited number of people in the Netherlands do take a big chunk of the operating margin from the value chain. This visualization is typically a good visualization technique of value chains if you talk to the board of a company. If you can tell the business model through this visualization, then obviously you do two things at the same time. The board recognizes their business model and also typically is surprised how the numbers work out in a geographical way. However, that is important for the area of taxation. If we then move to the second visualization model, which is the next slide. We look at what I would call a Michael Porter's modified version. So we take EBIT as a starting point, so our operating profit, and we can allocate EBIT based on people. That seems to be a suggestion made by BEPS or based on legal entities. But in essence, we're doing a carve-out exercise. So on local sales or marketing offices, we give either a cost plus or a percentage of revenue. Then we say, okay, we have some manufacturing and R&D which we apply a cost plus with because they're subcontractors of the lead manufacturer and lead R&D hub. And we have a margin for financing and treasury activities, which leaves us with a residual. So I'm working my way back in this picture. And that means I have a residual left for the IP owner and the matchmaker in the value chain. The matchmaker in the value chain is typically referred to in literature, management accounting literature, as the profit center. And the one who is the IP owner involved in the DEMPI functions is typically referred to in literature as the investment center. Well, those are the stakeholders to your residual. So this is a modified Porter's model. The third model is on the next slide, and typically is used if the value chain is much more integrated and intertwined. So it's harder to do this carve-out exercise. So can we have the next slide, please? So this is one approach. It's called balanced scorecard. There's other terminologies like process contribution analysis. Sometimes it is called, but you see functions, sub-functions, and the characterization. And here a simple example, just as illustration for you. 3 companies in the old days, in 2017, there's only the UK and Switzerland left. That is, those costs are based on interviews. So I'm typically interview then the people who are involved in these functions or these business processes, and I give them a cross if they are involved. That's the simplicity of the one pager. The weight characterization, so is if it's routine, it gets a weighting of 1. But if it's non-routine, I have to give it a higher weighting, and you need to go into literature. But literature could be a very good article in the Financial Times, which outlines what is the relevant real value drivers in a certain industry. As a consequence, you see the scores being weighted with this weight, and then you get into an allocation of the residual of a very intertwined type of business. So again, compared to the previous one, it's very hard to do a carve out. So here we are doing a process contribution analysis and thereby slicing the pie into various pieces. If we move to the next slide, then we have a 4th visualization of a value chain, which is a more strategic approach to value chains, typically used also by the boards if they define or redefine their strategy. And they define what are the customer segments we want to service, how do we deal with customer relationships, what channels do we use for our value proposition to generate a revenue stream, and what key partners, activities, and resources do we need, which generate a certain cost structure. And obviously in the strategizing phase, you need to also make an assessment whether the return, the delta between the revenue streams and the cost structure is adequate to be sustainable for your business. The next slide is actually a video taken from Nespresso, explaining how such an approach works.
My name is Alex Osterwalder. I'm the lead author of Business Model Generation and co-founder of Strategizer.com. I'm going to walk you through the business model of Nespresso, a company that sells coffee in the espresso business. So let's look at the value proposition first. It's composed of 2 products, the Nespresso machine and the pods that go with it. And we're going to look at the distribution strategy that Nespresso has. They sell the machines through retail to households, which means they earn a one-time transactional sales from selling the machines. Most of that money goes to the key partners, the machine manufacturers, who they work together with. And for the Nespresso pods, they have a totally different distribution strategy. They only sell the pods through their own channels. Started out with mail order and call center, then they built Nespresso.com, and today in the biggest cities of the world, you'll find Nespresso stores as well. This is interesting because it meant that they had to build distribution channels as a key resource in their business model, because this is the first time that a Nestlé-owned company sells directly to households. Now, why do they use different distribution channels for the machines and the pods? Well, they use retail because it has the broadest reach possible, because they want to get the machines into your household. Once you have it in your house, you're actually locked in because you can only use Nespresso pods. That's so-called switching costs, which prevent you from going to another machine manufacturer. And they defend that through the patents that they have in the key resources. And some of those patents actually expired last year, which means they need to renew their business model to a certain extent. Now, once you have the machine and you're locked in, you're going to have to buy pods from Nespresso, which means they earn money from repetitive pod sales. They create so-called recurring revenues. They change an entire industry from moving it from a transactional business to a repetitive business with recurring revenues. So interestingly here, they have recurring revenues, they have direct sales with higher margins, and they ask you for 5 to 6 times more for the coffee that you pay. So they get people around the world to pay much more money for the same amount of coffee. Now let's look at the left-hand side of the business model canvas to see what they need to have to do what they plan to do on the right-hand side. First of all, they need coffee. So they work together with coffee growers, and they try to source some of the best coffee in the world, which they put in the pods. And the pods is something that they manufacture themselves. So production of the pods is an important key activity, and they have production facilities to do that. They churn out 12 billion pods every year, which is one of their main costs. Another important activity and key resource and main cost is marketing and branding. Obviously, when you're in consumer goods, you need to put a lot of money into that. And the last piece here that's interesting is that because they sell directly to households, a decision made on the right-hand side of the canvas, they had to build up business-to-consumer distribution logistics, which we find on the left-hand side of the canvas. So now we have everything that's important for the success of Nespresso on one piece of paper. And interestingly, when Nespresso started out, they had a totally different business model around exactly the same product, and that almost went bankrupt. So it's only after a couple of iterations of the business model that they were able to find the business model that you see on this piece of paper and that led to a multi-billion-dollar business. So the difference was not the product alone. The difference were all the pieces here on the business model canvas that led to the success of Nespresso.
So this gives you an impression on the value chain of Nespresso using the 4th visualization technique, the canvas. And I typically, whenever we look at corporates, I typically like to understand their canvas approach, because that makes me understand their strategy better, and therefore I can do a better job in the value chain analysis. Here we're trying to combine on this slide, we have a transactional view of transfer pricing. So you assess a flow of goods, a flow of services, a flow of intangibles. That's typically what a lot of people do when they deal with transfer pricing. More and more often, countries like Germany, the UK, when you file an APA, South Africa, China, Australia, they have embedded in their law and legislation. They also want you to make a value chain analysis. And why is that? Because they want to see how those transactions stack up to the total pie and the slicing of that total pie. So that is the holistic view in this picture. Occasionally you have, in this case, the marketing and sales activity, if that is a brand related activity, generating an income stream of X for 5 years time, then you can apply a discounted cash flow on that and to come to the value of the brand. If the value of the brand is higher than, for example, the market cap of that company, you would really have to worry about the correctness of your allocation. So this is trying to pull it all together, transactional view, holistic view, which is the VCA, and specifically this discounted cash flow on the example of the brand. We move to the next picture.
Tesla was founded in 2003 and began selling its Roadster in 2008. Its first breakthrough was in 2012 when it launched the Model S. The Model 3 was announced in 2015 and manufactured in 2017. Prior to Tesla, the market for electric vehicles was relatively insignificant. Tesla saw a significant opportunity by focusing on performance and the high end of the market. In the design of its business model, Tesla wants to attract wealthy, environmental savvy and technology-early adapters. This is the first strategic step into the Tesla business model canvas. Value proposition. Through selling high-performance electric vehicles and delivering free supercharging stations, Tesla created a very appealing value proposition. Customer segments. Tesla unlocked a combination of the car market, which had not been serviced before. Beyond the Model S and Model X, Tesla decided to add to attract a wider customer base through the introduction of Model 3, a more affordable type. Channels. Tesla used its own sales and services center for a direct sale of the cars to consumers. In other words, cutting out the middleman. Even the delivery of high volumes of Model 3 took place at a harbor site in Amsterdam to all Dutch customers. Their exclusive supercharger network and infrastructure did enhance the message of your Tesla car provides you with the same level of mobility like traditional cars do, besides a range of 500 kilometers per fully charged battery. Relationships. By now, Tesla has the status of a lovemark brand, where through its own sales and services center, the relationship with customers is being kept. A remote upgrade of the cars is another premium service Tesla added to make their drivers happy. It allows Tesla to extract data from the movements of the car to the behavior of in the car and preferences on stops and other services, as well as the real-time measurement and management of the car's performance. Key activities. Tesla had to develop software to make all these car features happen. In other words, being a software package on wheels. Their stylish design and own developed production lines makes Tesla one of the only fully vertically integrated car manufacturers. Other car manufacturers are mostly assembling by acting as integrators, bringing together components and modules made by third-party suppliers. The big advantage of this is that Tesla can wire all the car components with the same software connections. Key resources. By launching a high-profile brand, Tesla, and by going to the stock market to pay for the investments in manufacturing facilities, as well as the supercharger infrastructure, Tesla has become a challenger of the traditional car industry in less than 10 years. As a sidestep, to address the magnitude of the impact, it can be indicated that in the period September to December 2020, the market capitalization of Tesla has grown from $399 billion to $629 billion, making Tesla's market value nearly as much as the next 5 most valuable car companies combined. This obviously makes it easier to obtain investments for growth. Recent plans for expanding the production locations to Germany and China feed the exponential growth of this visionary company led by Elon Musk. New developments on battery technology will continue to provide Tesla a head position in this industry. Competition, like GM, is catching up, with innovative ways of controlling its latest battery pack wirelessly, over-the-air updates for its vehicles, and driver assistance software in its Cadillac brand, that is as advanced as anything else on the road. Key partners. To protect its market, Tesla is working with some exclusive partnerships. For example, Panasonic is the battery partner of Tesla. However, Tesla would not be Tesla if it is not already on a development journey to producing cells. In the end, Tesla might continue to keep its market share lead in the electric cars industry by mostly teaming up with technology partners. Cost structure. In July 2020, Tesla reported its 4th profitable quarter in a row for the first time, but part of the cost recovery revenues came from selling regulatory credits to other car manufacturers. Therefore, running its current structure by making almost everything yourselves is more costly due to lack of volumes, and therefore will be one of the biggest challenges for Tesla. Revenue streams. The revenue stream is coming mostly from car sales, where the earlier types in volumes were not always right on time. It looks like the stabilities of the revenues is getting better with a Model 3 production line, after various hiccups, running smooth.
So this is a illustration of the Tesla as a car manufacturer, as a cars as a seller of cars, or is this, if you see this video is made by us a few weeks ago. I think 2 weeks ago the market cap of Tesla exceeded 700 billion and made Elon Musk the most wealthiest man on the planet. And the next question is, are we really talking about cars, or are we talking about data on wheels? So that to warrant that level of market cap. If you talk data on wheels, suddenly you're looking at a different business model altogether, and that sort of comes back to what this video was about. If we take a next step, then what we looked at, the first 4 types of visualization of value chains were linear. They had some production, distribution, marketing to consumer. The platform economy companies, and I consider Tesla to be one of them, although I guess it's still considered to be a hybrid, is running a circular economy. So it connects different parties through a platform to each other, and sort of optimizes the win-win-win for all participants. If we move to the next couple of slides, we have a Q&A. Is there any questions at this point in time? Yeah, Giorgio, did you or the host pick up any questions? If not, then let me continue on this. Daniel, you want to take over?
Yes, thank you, Steve. Yeah, continuing on the Tesla video, who is on its way to platformize the car industry. If we're looking at different degrees of platformization, we have the highly platformized markets, we have the semi-platformized markets, and the soon-to-be platformized markets. We made a few infographics, one of them for the hospitality market, which we're looking at right now. And what we're looking at is, what is the impact of data / tech giants on an industry? So in the value chain before, the top of the picture, you as a customer, you're going on a holiday and you're probably calling one or more airlines to book a ticket, to find the cheapest ticket, to find the best spot. Subsequently, you're booking to a few hotels in the area where you want to go to see if there's availability. You might want to rent a car, so you call a couple car rentals. Maybe you want to do an excursion or a trip to the mountains, so you need a guide. Now, well, to be honest, I never went through that value chain as a customer. I always did it through a platform, either through Booking, Airbnb, Skyscanner. And I assume that 90% of the audience right now is doing that too. So what is happening? The airlines and the hotels and the car companies are marginalized. So they get a revenue or a fee based on a transaction that is being done through the platform. So they're just a player around the big spider that we call the tech giant. Question to the audience, and I believe we have a poll even, or we didn't. Oh yeah, we do. I see a poll on the screen. What is the COVID-19 impact on platforms in this market? I'll give you all a couple seconds to answer.
Come si vota? Come si vota?
Okay. Can we see also the answers to the poll or not?
Not sure we get the results soon enough, Daniel. I suggest we move on to the next infographics, also due to time.
Okay, we'll do. I don't have the screen. Can someone move to the next screen?
There's one question whether people would get a copy of the slides. I believe the answer is yeah. Well, here we have the results.
Yeah. Significant negative impact. Yes. Thank you for those answers. Yeah, most of you answered significant negative impact. Yes, that's true. The entire industry was hit. But if we think a bit further, these platforms usually have a very low cost structure, a very slim cost structure, because if you count the number of FTEs in such a platform, it's way less than work for example, an airline. A couple of airlines have been going bankrupt during the COVID crisis, but I believe the platforms, yes, they have been hit, but not as significant as the players in the industry, the marginalized players like the airlines and the hotels. Can we move to the next slide? Yeah. So we just looked at almost fully platformized market. Now we're looking at a semi-platformized market, the banking industry. We're seeing three different models. The traditional model, where you would go to the bank that is down the street. You would sit down, look someone in the eyes, and explain them what you're looking for, and they would help you. Then we have the advanced IT model, in which you have a lot of different apps and a lot of different cards in your wallet, and you can do a lot of different things with it. So one app for insurance, one app for payments, one app for payments across borders. So everything's working, everything's digital, but there's a lot of different companies that you're having an interface with. And then the third model is the integrated IT backbone. Myself, I'm using ING, and I like the app very much, and I can do everything from that app. I have a credit card, I have insurance there, I can invest from there. I can honestly do everything from there, but that doesn't mean that ING is the one who is the owner of all these services. No, they're just delivering the interface in which I can do all my banking and other financial things. For example, if I go to a store and I want to pay with my phone, which is possible because I have an iPhone, I can pay with Apple Pay. They don't own Apple Pay. They're just using, ING doesn't own Apple Pay. They're just using the infrastructure that is there, that Apple is providing, and they're putting it on the interface of my phone, which I like very much. That doesn't mean that they are the owner of it. So they're just integrating all these services into one application. Question to all of you again. I believe a poll is coming up. Which of the three models will dominate in the future?
a signal of the banking industry being motivated by the European Union to rationalize its traditional banking model. It is clear as well. They want to. The EU wants that through mergers of the traditional banks, wants to make the traditional banks more ready for the future. I'm not sure just being bigger, it means being more adept and more ready for the new business models in the banking industry. So I'm sort of keen to hear what the outcome of this poll is. Are we almost there? Otherwise, we need to move to the next slide.
Integrated IT. Steve, you want to comment on?
Yeah, I think this is the integrated IT backbone seems to be the more dominant model, at least according to this audience, and I tend to agree. So let's move to the next infographics.
Then the last of the three, a market that is not platformized yet, but we already made a video, I believe it's 4 years ago, and the title of the video was, "Will Apple be your next doctor?" At the time, nobody believed us, obviously, or nobody answered yes to that question. But if we look at the diagnostic model and the preventive model, left side is the model we still live in now. So you go to the doctor once you have pain or you're feeling sick. And the right side is the more preventive model. And why preventive? Well, you have an Apple Watch and that measures your the warmth of your body on a real-time basis. It measures your pulse on a real-time basis. And you have many objects around you. Sometimes you're not even aware of them, and that measure your biometric data. So in a few years, before I'm going too fast, actually, let's start the poll right now. I'm curious about the answers. So the question is, where would you go to, let's say in 5 years, if you're feeling sick? Would you go to the hospital? Would you go to the general practitioner first? Or would you ask your pocket doctor / Apple or whatever tech giant about your current state?
The statement here that Apple has closed contracts with 500 plus hospitals in running the electronic patient file, and in return can do the data mining was being shared by a few hospitals with us. So it seems like Apple is, and Apple is not the only one. Google has a special department for health tech. Even Path IU is building its own health tech segment. So all these platforms are very keen on the biometrics. And it seems like our audience is already used to the pocket doctor. So yeah, that's very interesting to see that response. Yeah. It was different 4 years ago when we made the video. Everyone was a little bit laughing about it, as Daniel said. Okay, let's, given the time restraint, let's move to the next slide. So if we look at Apple as one of the bigger players, and let's look at something which is physical again, like an iPhone. You buy an iPhone, say for 1,100 euros. The cost roughly, this is a guesstimate. The best guesstimate is around 400 euros, including supply chain cost. That leaves 700 euros margin, which need to be allocated between, and in this particular case, the Bermuda Irish company, which is owning the non-US IP in the old structure. Again, this is public domain taken from the EU state aid case against Ireland on Apple. Ireland had ultimately about 5,000 people on the payroll, and the distribution was taking place through third-party distributors who were making, in certain cases, 10% of gross margin on the sales value, and also through Apple-owned stores. So rather than looking and reading the EU state aid case against Ireland, which is blurred with a lot of terminology and statements on individual transactions or location of people. Here we are applying a supply chain, a value chain type of analysis, where we say, okay, where is the difference between 1,100 and the 400 production and supply chain cost really landing? Is it landing in the Apple-owned store? Is it landing in Ireland with the 5,000 people? Or is mostly or should most of that value add be landing in the IP, the non-US IP owner? Looking at the threats and opportunities here, looking at bargaining power of both suppliers as well as buyers, the threats of substitutes like the Huawei's of this world and the Samsungs, and including the rivalry. So that this is looking at a simple value chain analysis. I think there's a lot of things been said on Apple, but a simple value chain analysis is typically what I would be interested in to defend a tax position. Let's move to the next one. So how do we tie this back to the references we know from the tax arena? BEPS is run on return on investment. So BEPS has introduced that there's no difference between a tax reality and a business model reality or value chain analysis, because BEPS says, well, it's basically the way the business is run and the people's conduct, which is driving where value is being created. So the ROI is their measurement on that. So why did OECD come up with Pillar 1? Well, they said, well, if we allow that to happen, then in certain cases where we see highly digital business models or consumer-facing businesses who have hardly any presence in the market jurisdiction, it might not be fair to not allocate a portion of the residual profits in this table amount A back to the market jurisdiction, because it's really the people in that market jurisdiction which allow this platform run model and platform run economy or circular economy to make money. So in the absence of local actors, basically the model doesn't work. The platform ties and connects various parties, and because it connects various parties, it can make a margin. It can make a transactional fee. Pillar 1, however, if people read it, 250 pages does indicate it has some complexity and it's not that simple, but the table 6.1 and 6.2 that do give you the quantification on how OECD has promised through the Financial Times to the market that $100 billion of profit will be reallocated to the market jurisdiction. Again, here is a political choice, and there's not really an economic supporting evidence for that full analysis. Well, there is, but it's not given in the 250 pages in the terminology we know from BAPS. So how do these two relate? The BAPS approach and the Pillar 1 approach, which is for now the formula based on politicians creating a compromise. Well, if we go to the next slide, we basically say, okay, BAPS, the beyond BAPS, so the Pillar 1 is looking at a profit allocation, and it follows a return on data metrics. And what do I mean with that? If I look at the platform economy and the performance of a platform economy business model, then I look at the growth of the number of participants in the platform, how much money you make per participant as two, and if you have one or more business models. So Apple has an iStore, and Amazon has multiple business models from books, from groceries to pharma. Obviously, that extends the lifetime of such a platform, simply because if one business is sort of over the top, the other comes up. All of that runs on an ROD performance metrics, and that sort of explains as the high stock market, the high market cap of these companies, because even in times of crisis like the COVID, they're still running a lot of data cells on their platforms. So ROD is basically the ROI, the BAPS on the routine portion, and a premium platform profit on the excessive part. So coming back to the Pillar 1. If we try to understand what that really means, and we go to the next slide, where I visualized taking a hypothetical example of Google, and Google has various activities, headquarters, sourcing of data, R&D, and so on. And it has developed a platform. If you look at the left side, it's creating data, collecting data, cleansing data, and all the way down to the process of monetizing and deployment of that data. And it gets crosses depending on who's doing what. Again, hypothetical, based on public domain information. How is Google able to make money? Well, they're only able to make money through the local third-party actors who use the platform. So they use the platform, they buy or supply through the platform. There's an internet service provider. There's, in some countries, there's server parts on which this all runs. So as a consequence, you basically say, okay, this platform premium is only achievable if you have local third-party actors. In the absence of Google being present in a country, you would, in a normal BAPS scene, not attribute any profit to it. What Pillar 1 really is doing, and this is the economic explanation of that, it says, well, without the local actors, Google would not be generating that profit. So we have to take the local actors into account. So if you take the crosses on the local actors, 13 compared to the 29 at the value chain of Google itself, you get to 20, sometimes 30. We've run a couple of models on an article which will be published later this year or early this year, where even the local actors' contribution, again, it's unrated, goes up to 40%. So this gives you an economic way and a value chain type of way to analyze what is the value contribution and add by the local third-party actors. Again, that's beyond BAPS, because BAPS only takes the actors within the multinational itself. Moving to the next slide. Different view. If we look at the heat map tax integrity risk, in this case, the Dutch central bank imposes on banks like ING, Daniel was referring to. They basically say to those banks, know your customers. So how do they look at corporates? Well, they say if the corporate is in the oil and gas sector, the sectors in this table, apologies, this is a table still in Dutch. If the oil and gas company is located in the Cayman Islands, so jurisdictions, if it uses a UBO financing as the product from the bank, and if the client runs it, say through a trust, then obviously you create a very high risk profile, and suddenly this first set of data points on know your customer also starts visualizing some sort of value chain and how the flow of money runs. So this is how banks are imposed by the central bank to watch out for the tax integrity risk on their clients. So if we take this one to the next level and say, okay, but this is a bank on behalf of the central bank doing this check. But if we take it to the next slide, there we see the country by country approach. Country by country approach. Can we go to the next slide, please? We all know the country by country approach, where a corporate hands over a privately performed country by country report to a local, typically the headquarter location tax authorities, and then the tax authorities share it with other countries where that multinational has operations. The banking industry is already filing its public CBCR for quite a number of years. And I took a snapshot from the annual report of Barclays, where this is only the visualization of what is happening in the UK. And what do you see? It has turnover, it has profit and loss, it has tax paid, and it has the number of employees. This all circles back to my first slide of the slicing the pie approach, where I basically said, if you slice the pie and you use those variables, you do that on a geographical base, you should be able to explain the business model and why certain data points do create certain financial ratios compared to other countries. So here the first statement is we are one of the largest banks in the UK with operations spanning all business lines. That's the opening statement. And halfway where the red cross is, in 2019, we did not pay UK corporation tax. Mind you, they paid a lot of other taxes, as you see from the table, but no corporation tax. That triggers type of a direct reflection of, if you get full transparency on your value chain, and really these data points, if you look at all the countries Barclays is in, give you quite a good sense of what the value chain of Barclays, how that is organized in terms of data sets. It does visualize that CBCR, we look at as a few innocent data points, does create a full data set, allowing you to do that pie chart analysis, which was the first slide I started my communication and presentation with. So although CBCR doesn't look like a value chain analysis, it does generate data sets which allow you to sorry, we get the poll again. I think we addressed that. It's just an insight if CBCR moves to a real-time CBCR and maybe even a public CBCR, which is not clear, but certainly banks already are in that space. Then how do you explain to the market that your value chain leaves this much money there and this much money elsewhere? Next slide. We have Netflix as a video. I would
Before Netflix and chill was a thing, no one imagined that one day they could have their favorite shows on demand just a click away. After a series of disruptive innovations and defeating the DVD industry, the video streaming industry is now a huge market experiencing fierce competition. But one company is king, and that's Netflix. With a whopping subscriber base of 117 million users and a history of successes with original shows such as Stranger Things, Orange is the New Black, and Narcos, Netflix is on a winning streak. But why is that? How does Netflix know precisely which content viewers would enjoy and which course to choose for its future productions? The answer? Big data. Through big data and analytics, Netflix manages to make informed business decisions throughout its value chain. Did you know that Netflix monitors your viewing behavior? They've created algorithms which collect data on how often, when, and where you watch their content, what device you use to watch, which scenes, colors, and music you like. The list goes on and on. By analyzing all this data about their users, Netflix can recommend content, choosing the perfect portfolio of future investments, and attracting even more subscribers. But the success of Netflix might be cut short if it doesn't play its cards right. The main threats the company is facing don't come from the competition, but from Netflix's own ambitions. For 2018 alone, the company is planning to spend $8 billion on original productions, which could eat considerably into their bottom line. The capability of Netflix to outgrow its expenses is doubtful. In 2017, the free cash flow was minus $2 billion. Will Netflix be able to create enough top-notch productions to sustain its spending? Let us know what you think in the comments, and give us a thumbs up if you liked this video.
So just a short comment on this. This also indicates that since this video was made, Netflix got Disney, got Apple, and a few others as its competition. Amazon with its streaming. So you see that even tech giants don't have an internal life. They also are at a certain point in time in the competition. So let me go to my closing remarks. Why, Pier Giorgio, his question, why is can I have the next slide, please?
Next.
Why is a value chain analysis relevant? Well, because it does give you the total picture. Why is a canvas strategy analysis relevant? Because it gives the business model a strategic context. So my key takeaways when I'm dealing with transfer pricing is always describe your business model and value chain, explain who's doing what, the governance, document your operational transfer pricing, and don't fall flat on using jargon like TNMM and CPM. I know we need to educate and explain it to tax inspectors in the end, but stick close to your value chain and your operating business model. Then apply a reasonable allocation of global profits to your group companies. And there's even talks about simplifying the whole allocation of residual. We shared a few ideas, and Pillar 1 certainly added a few there as well. Have a predefined set of dispute resolution tools ready when you know the residual is going to be certainly after governments need a lot of money after Corona, they will focus on the residual part. There will be a whole host of digital transformation, which you need to account for as well, and not in the latest, the tax authorities who want these data sets on your business as well to make their own risk analysis and make sure the board is on board on doing the communication to the relevant stakeholders, as we saw with Barclays. That's quite a wide audience, including the public domain. And with that, I would like to give the word back to Pier Giorgio, and thank you for your attention.
I would like to thank you, Steph, for your very comprehensive presentation. I fully share with you that the value chain analysis assists in achieving an understanding of the structure and organization of multinational group. And it is also relevant to understand how these factors influence the industry in which every company operates. And also, I think it's really important to better understand how the functions, assets, and risks are the key indicators of the real substance of a company and its operations. So I think this is a quite relevant area. The VCA is becoming a mandatory part of a standard transfer pricing documentation exercise. So we are ready to work together and to assist our clients on that. So this is, as I said in my introductory remarks, this is the first seminar we decided to have with TPA and with staff. And I'm looking forward to working with you again, staff, and with our partners, and to assist our clients, our multinational clients, on these topics. I would like to thank you again. Steph, do you have any closing remarks from your side?
No, thank you, Pier Giorgio. I think we're running out of time. One point one of the participants made and said, if you do VCA, it deepens your requirements to access penalty protection awards. So that there's a common sense that people say if you make that extra mile of effort, certainly you should get penalty protection as a compensation to that. So that's just a side remark. Thanks again.
Thank you. Thanks very much. This was the first seminar, Law 1 Tax and TPA Global working together. Thank you very much. See you soon. Bye.